faithfully delivering value, interpreting great books from around the world. Hello, this is Sally's Book Club. Today, the book we're interpreting for you is Fooled by Randomness. When you hear this title, you might wonder, what exactly does fooled by randomness mean? Actually, the original English title is Fooled by Randomness, which literally translates to the fool who's been tricked by randomness. Randomness is a concept from probability science, standing in direct opposition to determinism. It means that any given event could potentially unfold in countless different ways. Take archery, for example. If you're not a professional and shoot at a target 10 meters away, that arrow could land anywhere, randomly, even miss completely. If you somehow hit the bullseye, you'd probably credit luck rather than skill. But those fooled by randomness misunderstand this completely. When random events occur, they don't attribute them to chance, but mistakenly believe it's their own ability at work. Oh, the financial markets offer the perfect stage to observe randomness in action. Thousands of traders make countless daily moves where stock fluctuations prove as random as that archery example. This is precisely the phenomenon author Nassim Taleb set out to examine. Nassim Taleb, renowned trader, risk analyst, and NYU professor, wrote the bestseller The Black Swan, another work on randomness translated into 31 languages. Globally recognized as essential reading for Wall Street professionals, Taleb fundamentally believes in randomness. He argues that while low-probability events like 9/11 or the subprime crisis seem rare, they inevitably occur, often catching markets unprepared with devastating consequences. But are we truly powerless? Taleb proposes we learn to accept randomness, protect ourselves against its extremes, even profit from it, rather than being its fool. Now I'll explore 3 key aspects of the book with you, examining how to transform unavoidable catastrophes into strategic investment opportunities. First, what defines a successful investor? Second, what traps commonly exist in randomness-filled markets? Third, how can we avoid traps and not get fooled by randomness? Let's address the first question: what makes a successful investor? Consider this example. Taleb and John were both 90s Wall Street traders, neighbors on the same street, yet their wealth gap was enormous. Taleb entered the industry a decade earlier, yet John's net worth was 10 times higher. Why such disparity? It stemmed from their completely opposite trading styles. Taleb was extremely risk-averse, never investing managed funds in high-risk trades. He avoided leverage, didn't borrow from banks, and exercised extreme caution in all matters. Whenever trades hit certain loss thresholds, he'd immediately exit, never waiting for recovery. Taleb earned through commissions, averaging about $500,000 annually. He wouldn't invest personal money in stocks, viewing markets as too volatile, bull to bear in moments. He avoided risking savings, focusing solely on wealth preservation through safest methods. Thus, Taleb only bought government bonds, considered the safest investment. Returns were minimal, of course. Ultimately, Taleb's principle was safety, avoiding being blown up, meaning total wipeout without recovery. His goal wasn't maximizing profits, but maintaining enough wealth to stay in finance. John's trading style, however, was the polar opposite.
John traded high-yield bonds, routinely buying riskier 10% yield bonds from multiple countries.
He leveraged bank loans to invest multiples of his capital, multiplying profits. John's income came from hefty commissions and bonuses, plus reinvesting nearly all personal funds. By age 35, John had about $16 million, investing $14 million of it. Through leverage, he secured $36 million in bank loans, totaling $50 million invested. Over his 7-year trading career, John earned approximately $250 million for New York investment banks. He himself amassed a fortune, living in mansions and driving sports cars. Taleb and John, these two traders with opposite styles, looked down on each other. Taleb believed that shallow, arrogant John only prospered because his flaws hadn't been tested yet. Taleb was convinced high-yield markets were like napping on railroad tracks. Eventually, you'd get hit by a train. John saw Taleb as a minor player, overqualified yet useless. stuck in conservative, outdated strategies. After years of trading, he hadn't made any real money. So, who do you think was the successful investor? You might assume the higher earner, John, was successful. Let's continue their story. One September 1998 day, Taleb saw John disheveled, smoking in his front yard instead of working. John had been fired because high-yield bonds crashed throughout summer 1998. In days, John lost over $600 million of company money plus his entire $14 million investment, even owing an extra million. John was blown up. No capital left for recovery. Taleb, avoiding high-yield trades, remained unaffected and kept working through the 1998 crash. Now, who seems successful to you? To the author, John epitomized the fools fooled by randomness he criticized. John's profits came not from skill, but the overall bull market between 1992 and mid-1998. He merely entered the right market at the right time. His style coincidentally fit the bullish trend, multiplying money through sheer luck. Luck, not ability, built John's wealth. When markets turned, John's luck-dependent fortune vanished with bad luck's arrival.
Compared to John, Taleb is the author's model of a successful investor.
Taleb believed low-probability events could strike any time, instantly destroying the unprepared. Out of reverence for market forces, Taleb avoided high returns and thereby high risks, because he considered survival in the market paramount. Many share the author's perspective. When asked about investing, economist Justin Yu-Fu Lin replied, "Just use fixed deposits." Robert Shiller, Nobel laureate for studying market irrationality, advised simply saving more at banks when discussing investments. Even Warren Buffett summarized his investing wisdom. Success comes from avoiding big mistakes. Few right moves ensure profit. All right, that concludes part 1. We've examined Taleb and John's stories here.
Taleb's inherent caution led him to low-risk investments, modest earnings but enduring market presence.
John embraced high-risk leveraged bets, huge profits until risks materialized and destroyed him swiftly. The author contends true success means acknowledging randomness and avoiding catastrophic errors. Market survivors. After part 1, you might wonder, why do people get misled by randomness, and why emphasize mistake avoidance? Because randomness-filled markets are riddled with traps. How to spot these traps? That's precisely part 2's focus. I'll explain 3 traps from the book. First, survivor bias. Second, misattributing causation. Third, ignoring skewness issues. First trap, survivor bias. What is survivor bias? It means we only observe successful survivors, never the failures who vanished, thus distorting our observations.
Take Taleb and John. While both traded, they represented observable success cases.
But after John got blown up, he disappeared from our observation pool. Essentially, survivor bias reflects insufficient sampling, only counting winners while ignoring those who failed and exited, leading to inaccurate conclusions. End quote. Reveal the sample size, and the picture changes completely. The author gives this example. Suppose there are 10,000 fund managers. Year 1, 45% profit. Year 2, 45% of those 45% profit again. That's 2,025 people. By year 5, just 184 remain. These superstar traders with 5 consecutive profitable years. Well, but what percentage of the original group do they actually represent? A mere 2%. Broaden the sample, and you realize failures vastly outnumber successes. We only see survivors mistakenly believing market profits come easy. Now, the second trap, misattributing causation. People often assume market events must have specific causes, but is this always true? The author argues that forcing causal links can be akin to superstition. For instance, when a lost cab driver once dropped him at an unusual south entrance to his office building. That same day, exchange rates swung wildly. His portfolio surged. Next day, when another cabbie asked his destination, he instinctively requested that south entrance. He convinced himself that unfamiliar doorway caused his luck. Many firmly held causal links in investing prove equally unfounded. The author cites trader Carlos, economics master's and PhD holder, Carlos believed he deeply understood emerging market bonds. Economically, he saw massive growth potential in these nations, making him bullish on their bonds. From 1992 onward, he steadily profited by buying such bonds. But summer 1997 brought a crash, wiping out all Carlos's gains.
Years of $80 million profits vanished, plus an additional $300 million lost that summer alone.
According to the author, Carlos established false causal relationships. Carlos trusted economics but never considered that past successes based on economic variables might have been coincidences. Or worse, economic analysis works for past events, but actually masks their random components. His approach happened to work when he entered the market, but he never tested if his analysis held when markets turned. Because when markets shifted, he was already wiped out. Plus, overemphasizing causation can sometimes eliminate the causal relationship itself. The author observed a period when markets consistently surged on Mondays, leading people to buy on Fridays, until excessive buying erased the Monday surge pattern.
Having covered the causation trap, let's examine the third. Ignoring skewness.
What is skewness? Essentially, asymmetry in probability distributions.
The most classic example, black swan events.
Here's the black swan concept. For millennia, Europeans only saw white swans. They concluded all swans were white, until Europeans discovered black swans in Australia. That single black swan overturned all prior assumptions, like the Titanic, branded unsinkable, yet sank on its maiden voyage after hitting an iceberg. Or imagine a gun with one bullet having a 1 in 6 chance of firing.
Would you point it at your head for $10 million?
The author insists it's never worth it. Why? Because failure means death. Thus, understanding skewness means recognizing. If failure's cost is unbearable, success probability becomes irrelevant. This applies equally in investing, yet many remain unaware, falling right into the skewness trap. For example, when asked to predict weekly stock gains, the author once estimated 70% probability. Another person interjected, "If you think there's a 70% chance of gains next week, why did you brag about buying short futures, betting against the market?" "Oh, Michael," the author explained, "while the probability of gains is high at 70%, the potential increase is only about 1%.
If you buy stocks solely based on high gain probability, a potential 10% drop could wipe out all accumulated profits instantly."
Thus, the author believes profit likelihood alone is irrelevant. What truly matters is how much you can actually earn. This explains why the author bought massive short futures. All right, that concludes part 2. Here, the author outlined 3 common market traps. First, survivor bias. We only see winners while failures exit unnoticed, skewing conclusions. Second, misattributing causation. People assume market moves have specific causes while ignoring luck's role. Third, overlooking skewness, where low probability events cause massive disruption, like black swans. Hence, the author stresses, if failure's cost is catastrophic, success probability becomes meaningless. Having understood these randomness traps, we proceed to part 3. How can we avoid traps and not be misled by randomness? Financial markets' defining feature is extreme randomness. Amid economic, political, global, and natural disaster factors, black swans can strike anytime. Truly, markets' only certainty is that black swans will arrive. Our task: become clear-eyed investors who accept and leverage them. But how? I've distilled the author's insights into 4 principles. First, avoid path dependency. What is path dependency? It's when subsequent ideas blindly follow the initial assumption. Example: buying a stock at $16, expecting $20, vowing not to sell until target. When it hits $19, you refuse to sell for not meeting expectations. Then the market suddenly reversed. That stock plunged from $19 to $14, yet you held on because you were fixated on hitting $20. Meaning every subsequent decision was dictated by your initial won't sell below $20 stance. That's path dependency. To avoid randomness traps, Rule 1. Resist being swayed by past experiences or preset biases. Simply put, don't cling rigidly to ideas. On this, legendary trader George Soros exemplifies perfectly. Soros could revise his views astonishingly fast. Once, trader Julian played tennis with Soros. Mid-game, Soros argued markets would likely crash, citing complex reasoning. Clearly, Soros was preparing to short the market. Yet, days later, markets surged to record highs. Julian worried Soros's portfolio was bleeding. At their next tennis meet, he asked about losses. "We scored big! Made a killing." Soros said, "I changed my mind, covered my shorts, and built huge long positions instead." See, Soros carried no pride. He adapted decisions purely to current realities, unshackled by preset biases. Each day was a blank slate. Beyond avoiding path dependency, we must learn to mute noise, the second key to dodging randomness traps. Principle 2. Often, people aren't unwilling to change views. They're drowned in noise, paralyzing decision-making. To mute noise, the author suggests 3 approaches. First, reduce frequent trading. Many obsessively watch tickers. Every price flutter spikes their emotions. The author deems this wasteful and meaningless. Constant monitoring shows price movements but doesn't boost returns. Consider an investment with 15% return and 10% volatility. Using normal distribution calculations, profit probability is just 50.17%. Per minute, 54% daily, 57% monthly, but 93% yearly. That's why short-term traders often earn less than long-term investors. Second, consume less news. The author believes news media generates noise, especially daily news, prioritizing speed over depth, while easily swaying people. Instead, talk more with experienced elders. The author particularly values conversations with veteran investors who survived rare events through unique strategies. Such experience is invaluable for newcomers. As the saying goes, "I've been around the block more than you've walked the street." Avoid randomness traps. The third key point, set stop-loss limits.
Randomness strikes suddenly and unpredictably, often with severe consequences.
Stop-loss limits become crucial here. Cutting losses protects against black swan impacts. The author mocks those without stop-losses. Many losers just reinvent themselves as long-term investors. Refusing to accept reality, they won't cut losses decisively. Fourth key, leverage black swans, even profit from them. Convinced of black swans' inevitability, the author constantly prepares for their arrival. Before September 11th, he massively bought deep out-of-the-money warrants. This unique short position against U.S. markets made him overnight wealthy post 9/11. Similarly, before the subprime crisis, he heavily shorted markets for massive profits. While we can't replicate such moves, we can adopt his allocation. 80 to 90% zero-risk assets, 10 to 20% high-risk bets, abandoning mediocre return investments. So zero-risk investments preserve wealth, while high-risk allocations provide black swan profit opportunities. That concludes Part 3, having understood market traps, how do we avoid pitfalls and emerge victorious? I've summarized 4 key points. First, avoid path dependency. Don't be boxed in by old thinking. Got to adapt on the fly and tweak strategies quick. Second, learn to block out noise, like cutting back on constant trading, skipping the news and papers, and chatting more with seasoned folks. Third, learn to cut losses pronto. That way, you dodge the hits from black swan events. Fourth, get savvy with asset allocation and try to cash in on black swan events.
Oh, nowadays, black swans pop up all the time. Who'd have thought back in 2020, the whole world would get blindsided by a virus called COVID-19? Thrown into total chaos?
What if randomness really hits you personally? What then? At the book's end, the author talks about facing failure with grace. First, stand tall, show some pride, and act elegantly to prove you know how to survive no matter what, because Lady Luck can't control your actions. That wraps up Fooled by Randomness for you. Reading notes are below the audio. Catch you next time.